I've had people ask me, what do I do with money? How do I even start this whole investing thing? Like, I've heard people talk about investing, and I don't even know where to start. And I've also heard, oh, can I double my principal in one single investment cycle? I've heard stuff like, should I wait till I'm old before I'm able to liquidate my investment since I'm saving for the future? And I just think to myself that that means we really need to talk about this whole investing thing. So, if this sounds like you or you need this, come, let's have a serious tete-a-tete. Hello, professionals. Welcome back to the Stay the World Show. And today, before I answer your questions, I would like to address something I think is fundamentally the reason for the questions. So if you get what I mean, the cause of these questions or the foundations of these questions is what I think are the narratives that have been put out there regarding investing. So today we'll be doing two things. We'll be discussing the myths around investing, and then I'll be giving you 5 strong pillars that would guide your investment decisions and your journey through investing this year and beyond, in line with what the macroeconomic situations are. I hope now that you're hearing macroeconomic situation, it's not shaking you now, because you have seen the previous episode that talks about the macroeconomic indicators and a breakdown of all of them. So let's run. Myth number 1, investing is for the rich. I've heard people say, you know me, I don't have all these millions. It's only people that have millions of naira or millions of dollars that should be investing. And I'm here to debunk that even with your little money, you can do investment. So you remember that widow who her husband left a lot of debt for? She only had a little jar of oil, and she had to borrow containers and poured the oil into it. And what I see from that story was somebody who had just little, but with small consistent steps, she was able to multiply it and sell, and was able to pay off her debt. So look at investments in that way, to say, see, all I need is a little jar, my little money, I consistently put it into a vehicle that is able to multiply it. The crux of this matter is you don't need millions to start. You only need small, consistent moves to be able to build something out of nothing. The other myth is investing is the same as savings. No, they are not the same. Investing is different from savings in that investing is your funds that is passed through a risky channel to get to growth. Savings is your funds left in a comfortable current account and is not going to make any significant growth. So components of savings is just liquidity and comfort, accessibility really. But in investing, there are 2 components, which is risk and growth. So whenever you are looking at whatever it is you're doing, okay, say for instance, you earn money, you earn your salary, and you're moving it into another current account or another savings account, just because you don't want to be able to access it in your operational account, and you just move it there and you just leave it there. That is not investment. That is simply you saving your money. But the moment you decide that, see, this money that I've just been gathering, I need to move it into stocks, for instance, you have taken risk, because you are putting your money to own a fraction of a company that, if you didn't do your proper analysis, you might not know whether they are doing well or not. So yes, you have taken a risk, and yes, you can now earn dividend on that investment, or you have capital appreciation on that investment. So you see the difference. Another myth is If I can't double my money, it's not really worth it. So I've seen when people ask me, oh, this my money, I want to put it in an investment. And then you tell them, you can get around 14, 15% because of the volume. And if you are doing these volumes, maybe you can do around 20% maximum. And then they go, is that 20% per month or 20% per annum? And I'm like, if you see 20% per month, you go take them. Many times, when that question is being asked, that where should I put my money? The actual question is, where can I put my money and double it as fast as possible? But it doesn't necessarily work that way. Steady growth is what investing is. So if you're looking for something that would double your money, that's how people fall into all these traps of Ponzi, because you want to just do something quickly and earn something quickly as well. I recall there was a time when this whole forex thing was raining. If you put, in fact, you do spreadsheet and your spreadsheet will be telling you how much you earn in a year time. And plenty people put their money because, of course, they say figures don't lie, right? But this one, he didn't only lie, it actually deceived. But everybody that was on that table, they are all right now. Everybody's fine. Like I always say, go grandma, we're all right, last. And let me just remind you that chasing double is the fastest way to lose your principal. So that is not the way to go. Another one, land never loses value. You know that one, eh? The holy grail. Go and buy land anywhere and wait. What they don't tell you is that land actually appreciates based on three things. One is infrastructure. The more the area develops, roads are now there, lights is now there, people are now moving to the environs. That is when the value starts to go up. Another thing that drives land value is demand. The moment a certain estate opens up and then people start to demand it, you will see price move. Like I saw one last year and the conversation started around April. By the time it was entering December, I was like, is it the same place that we're talking about? So because there is now more demand, the price goes up. And the third thing that makes your land value appreciate is legal title. So if you go and buy land where these three things are not, you are just gathering assets that might not be able to save you on rainy days, because it would be very illiquid. First, you might not be able to resell it because you don't have any legal title to that particular piece of land. And then, any assets that you have that cannot really save you on emergency, I'm not sure that's what you want to be considering now as a young professional. And on this, it is always good to speak to verified professionals before you go and get your hands burnt. Money issues are real everywhere. It's not only particular to Lagos. Another one is dollar investment means no losses, or foreign currency investment means that I won't have any losses. Foreign currency investment would not, I understand that it's a valid hedging strategy against Nigeria that always shifts goalposts. This goalposting, I used to hear it where I was working before, where the company had said by the end of XX period, we should be $100 million company. But guess what? All the assets of the business was in Naira. When dollar was around 150, they became $100 million company in Naira assets, right? Because that's valuation. Then all of a sudden, dollar jumped to 450. Then they started running again. We started running. Again, we became $100 million dollar company. Next thing, we saw dollar jump to 700, 600, 700. Then we started running valuation race. Do you understand? So in a country that continues to move because of the volatility of currency, having a dollar denominated investment doesn't necessarily shield you from bad investing decisions, because the strength of the currency is not a substitute for asset quality. So what are the things that can make you lose value? Because I'm sure you'll be wondering that you can lose money in dollar terms. You can enter a bad valuation. You can enter too early and sell too early or sell too late, because of the volatility. And you can also invest in weak assets. So you see why I said that the strength of the currency does not necessarily substitute for the asset quality. The next myth I'll be talking about is, if it's regulated, then it is safe. You know, it's like saying that when I drive my car and I wear my seat belt, there cannot be accidents. Guess what? I was in an accident last year. And it wasn't because I wasn't wearing my seat belt. It was majorly because I wasn't looking. So yeah, while having the structures around regulation, CBN regulates this, the SEC regulates the assets I'm putting my money in. There's also a trustee structure. Fantastic things. Really, really good, because they are there to control fraud. But that does not take away your oversight, your personal monitoring. So like I said, I had an accident because I wasn't looking. I ran into a truck and then I had my airbag pop in my face. So it's the same thing where you are taking an investment decision and you assume that because it is regulated, then it is 100% risk free. Then you are believing in a myth that can pop in your face. A regulated fund can still adjust for yield. It does not, the regulation does not shield you from market risk. And market risk is any risk or any circumstance that can affect the entire market, not only the asset class that you have put your money into. So regulation cannot control that. Your assets can underperform and it can have liquidity pressures. So whatever it is, those things, regulation cannot outrightly take it away. So you still need to perform an oversight function on your portfolio at any given point in time. And lastly, investing means I lock my money in till I'm very old. You see this one, it has stopped a lot of young professionals, especially Gen Zs, from investing, because Gen Zs are like, why can't I access my money? What if I die tomorrow? But guess what? I hear things like, is investment not for retirement? Is it not because I'm just saving for my future? Is it not just for me to just lock it in? And no, you don't have to. So it's about how you look at what you have in your hands. Investing is actually not one bucket. So there is short term, there is medium term, and there is long term. So it's like you putting your money in different buckets and you're saying, okay, this one for short term. You see, next year, I want to ride a car and I'm budgeting to ride a 2021 Camry. And then you start researching the price. This car is now 22 million. And then you are now thinking, okay, how do I start putting money together? What investments can I do that can help me and support this my goal? So if that's your short-term goal, you look for buckets of investments that you can put money in. Or this one, young professionals are on this table. I want to get married. And I know the budget of marriage. In fact, that my babe likes high-end marriages. So, me, I'm not ready for marriage. Oh. If you're on that table, climb down because 2026 is your year. So, yes, you can invest for marriage. It's just for you to tell your investment advisor that you see this money, 200K per month. I want to be putting it in this locked investment. Just lock it up. It's for my wedding, you know? And by the time you are, by December, you want to go to O&B. This is just, which month are we in now? You know? By December, will come for your O&B. And me now, as your investment advisor, I'll wear agbada and come. So, investing is not until you are old. I hope with this viewpoint of mine, we can go and start to talk about what are the pillars you need to put around your investing. Because honestly, 2026 is not a year that you can invest blindly. I said in my last episode that all those macroeconomic reviews that people have done, all the commentaries and everything, is actually for you and I because it affects us the most. So, what can we put together? We're going to be putting together 5 pillars that would guide your investment decisions whenever you're about to make them. The first pillar we'll be talking about is to separate your money by purpose. So you're going to be, in one of our previous episodes, we had talked about an intentional investing in 2026. And allocation is one of the key points we had mentioned. And yes, this is it. So instead of asking, where do I put my money? Which is the first question many people ask. And what I ask after I hear that question is, what is this money meant for? What is your goal? What are you trying to do? So instead of asking, where do I put my money? You should ask yourself, what is this money meant for? What am I holding this money for? Because that would then guide how you would appropriate that money into 3 buckets. Again, you're going to be looking at liquidity money, stability money, and growth money. Your liquidity money are for your day-to-day runnings, utilities, emergencies, which stuff like you want to maintain your car and all of that. And this kind of money you can put in asset classes that are very liquid. Example is mutual funds. I know many people have heard about mutual funds, but you're like, how does it work? Who are the people that even manages all these mutual funds and all of that? We have asset management companies that have registered funds with the SEC, and they have it on apps that you can download on your phone. I'll give some examples. We have Emerging Africa Asset Management Limited, who has Emerging Wealth app that you can download. We have AfriInvest. AfriInvest has AfriInvestors, AfriInvestor app, I think 2.0 now. We have Stanbic IBTC Asset Management. Those ones have Blue Nest app that you can download, or even the main Stanbic IBTC application, and you can register. And we also have a lot of asset management companies. So you can just Google asset management companies in Nigeria or mutual funds that I can subscribe to. Google would list out people. You make your research. Due diligence is key. And then you can choose who you want to invest in their mutual funds. For your stability money, that is where you have a little bit of capital appreciation and modest returns. Yes, you are now beginning to invest. You can buy stocks, dividend-paying stocks. For stability too, mutual funds can still also fit into that bucket. And there are some locked savings platform too that you can use for your stability money. Just tell them 1 year lock away. They just lock your funds. And that would help you for some of these target savings that I mentioned, like your wedding ceremony, So that is another bucket that you have to allocate your money into. The third one is your growth money. You see this one, those are High risk, high return, long-term wealth building, long-term wealth creation. So this time you are thinking long-term. Part of the investments you can do under this bucket, you can have a real estate investment. You can also do stocks. You can do foreign stocks under this bucket in businesses that you know that in the next they are here to shift the space. Something like AI tech energy kind of businesses. So if you look for, you research those businesses and then you invest in them and go and rest. But you know that your rest, you're not just looking away completely, but you are just confident that okay, I'll be checking from time to time, but you know that your goal is to have those stocks for a very long time. Another one you can do here is own a business. Owning a business is also a long-term strategy. And really, anybody can own a business, right? Well, I'm not sure about that. But if you own a business, it's also a long-term wealth strategy because that's the goal. Last. If you are with me, let's meet. The next one is prioritize or respect inflation more than returns. Because in the real sense of it, the rate of inflation and rate of return can make your money actually shrink. So your real enemy here is not the return that you are being given. It is that there is a person, or is it a person now? There is a concept that we must do bother for. And that concept is inflation because it actually determines what your purchasing power would be. So when you are doing your investment decision, you're thinking of the real purchasing power. So you're thinking in buying power or purchasing power equivalents because of your lifestyle choices. Because sometimes what I would buy is not what a friend of mine would buy. So for instance, I was speaking to a friend of mine and she said, oh, I don't think 10K can cook a soup. And I'm like, what? What are you cooking? She said Efo. And I'm like, is it the same Efo that we are cooking? And she said yes. And I had to take her to my fridge to say, see, this Efo, I have it here. I have this, and I'm going to sum everything up. And the cost of my soup is not 10K. In fact, it cannot be more than maybe 5K. And she was like, oh, how do you do it? So because I buy in bulk and I've splitted everything. And then she goes for about 3 months after, she came back to tell me that, Omo, I executed that thing you told me. And I was surprised at using her tone now and her voice. I was surprised at what I was able to achieve. And I told her, yeah. So your buying power really should determine how you're thinking about your investing. And I'll give you a couple of tests to carry out when you're taking those investment decisions. So when evaluating investments, you ask yourself, does it grow faster than my cost of living, which is mostly personal to you? Can it adjust for economic differences over time? So it's like somebody telling you to come and lock money for 20 years and then they'll be paying you 50% per month for the 20 years. That investment, just run, because the time value of money, what your money is today, is not what it is, in fact, in the next 6 months. So why would somebody want to offer you something for 20 years? Do you understand? So if what you're investing in does not adjust for economic shifts, even bank loan, they will come and tell you it's a floating rate. Once anything shifts like this, they are sending you revised rates. In fact, they will not even send it to you. They will just adjust it on your app. If you know, you know. The next one is the return real after inflation? So if somebody tells you they are giving you 15% and then you adjust for inflation on it, you see that it's around 10%, and you're looking at it that, okay, is my cost of living really at 10% and all of that? So you have to check for the real returns. And then the other one is, can it save me in the day I would call on it? You know, sometimes you do investments and then you notice that you liquidate, money no go come. And then your landlord is already knocking at your door to say, come and pay my rent. And it's just becoming a whole lot of embarrassment. Maybe because where you had put the money was not a reliable vehicle, and then you have to start looking for the money. So when you start seeing traces or you start seeing signs, please go and call for your money wherever you have put it. And then the last one is, will this investment, if I am going to be living it, will it be able to fund my lifestyle in the next couple of years? So for instance, you are doing an investment and then you are doing a lifestyle shift. In fact, maybe not necessarily a lifestyle shift. Maybe it's just you getting married and then you are becoming two. Two shall become one. But in the real sense, the expenses are, I don't know if it really doubles, because you'll be eating the same, you'll be eating in the house more now and all of that. Well, conversation for another day. Maybe because of that, you ask yourself, this thing I'm about to do, can it suffice in the future? But remember that it still has to be a consistent growth. So you are not jumping up, you are growing up, and you are growing your investment assets by assets, and you are breaking it into different categories. And remember, the best investment options are not necessarily subject to whether they are high returns or low returns, but when you're making those decisions, you're checking out if they align with your future expenses, if they match your time horizon, and they grow with your life, not against it. The next one is you considering liquidity as a strategy, not you just wanting to keep money around. Sometimes you say, yes, yeah, you need to have cash because of days of uncertainties and all of that. But I agree with you. But the bad thing is idle cash. So yes, you having cash is not the problem. Remember, even in accounting, we have stuff that we call cash and cash equivalents. You see? So even accounting recognizes liquidity of asset classes. So yes, even though you're going to be investing, there should be a class of your investments that is liquid enough to be easily accessible to you on emergency for days. I don't know why I'm saying emergency in this video a lot, but it is important to be liquid, but not keeping idle cash. There is a difference. You can be liquid by putting your money into liquid assets. In fact, stocks are liquid too. The only reason that we don't classify them as liquid is because the day you might need it, the price might not be very favorable, which might deter you and want you to just hold on so that you're not losing value. So, but in terms of ease of selling, you'd sell a stock faster than a property. In your investment decision or in your investment portfolio, you are going to be having some level of liquid assets. Mutual funds is a very liquid asset, even though your money is still subject to modest growth. And the thing about this is, you just put your money in your mutual funds account and then you just open it and you see your money grow. Who has felt that way? And you just start to dance like, this money is actually growing. It's not loud, it's not shouting, it's just your money there and it's just increasing in value and you're just so happy. If you have ever felt happy that your money is growing, this is a time for you to like this video, share and subscribe, because I am always happy to own money. Another thing I can classify as a liquid asset is having some form of investment that is able to give you installmental cash flow. So I'll give you an example. You buy an asset, say a organizing machine. You find somebody that is interested in doing the business, and then the person gives you constant returns, say on a weekly basis. Maybe you bought it on hire purchase and the person has to make installmental cash payments to you. For me, that is some level of liquidity. You have your money on a weekly basis and you can finance your lifestyle from that particular cash flow. So that is also another thing you can consider. The fourth consideration when you're doing investment is look for assets that compounds, because compounding beats excitement. I know the thing I love about compounding is, yeah, you do an investment, you reinvest your interest starts to bear interest, that family tree that when your father is explaining your family tree to you, you know how boring it can get. Yes, that's how compounding is. But you just see that my grandfather now gave it to my father now gave it to, that's compounding. You are putting in your principal and interest, you roll over, but the risk here is you not living, or is, like I said, you cannot go to sleep. So you have to be informed every time. So if you are doing compounding, if you are playing a compounding game, you need to be aware of the information that is going on around you, so that you are sure that you are not going to lose both your principal and your interest at some point down the line. So, but if you are going for a long haul, compounding beats excitement anytime, any day. The next one and the last one I'll be talking about is you cannot outsource your thinking this year. Stop outsourcing thinking, because are you me? Am I you? Are you my friend? Am I your friend? Do you understand? Because we don't have the same preferences, we don't have the same lifestyle, we don't have, even if we are siblings, what appeals to me is not the same thing that appeals to you. So I cannot now say, oh, because they call it copy trading in forex, right? That there is a big trader, you just sit down and copy the person's trade. Oh, the risky. Because your choices, your investment goals are two different things. Your risk appetite. Okay, so because your mentor is doing something and then your mentor goes to tell you, oh, don't worry, this is how I do my thing. I put my money in this, I put my money in that. In fact, when I tell people what I invest in, I tell them that, see, I'm not saying you should follow my footsteps, because me, I know I'm a risk taker. And I know that I can be very spontaneous. Thank God I married a man that has brakes. So we balance the decision that way. But still, I can be very spontaneous. So the fact that I tell you, oh, this is what I do, this is how I make my investments, does not necessarily mean you can do copy and paste. So I'm not saying don't glean wisdom. But when you glean the wisdom, you need to refine it and adapt it to your own case-specific outcome. And that is why you need to know your why when you are investing. So if you are actually looking for your why, we are here to guide you in the right way to go to find your why. And that's why we are setting up the Stealth World Network to come and guide you as to what you need to do, how you need to do it in a structured manner. I've been shouting structure. I don't even know why I've been shouting structure. But honestly, you can listen to this podcast and still feel like, so where are you telling me to start from? I've given you what is holding you back. I've given you what I think you should do. I've given you even many asset classes with recommendations. But if you can still be confused, especially if your goal is to build lasting wealth, not just for yourself. So let me leave you with this. Wealth is not built by chasing miracles. It is built by ensuring that you are not making consistent losses, or you are not losing your principal. And one thing is very important in wealth creation, and that is stability and consistency. You must stay invested long enough to be able to see results. So if you invest, even if you do this mutual fund thing, you put 200k today, by tomorrow you have gambled and you need money, and then you go and liquidate it, it's not going to grow. It's just like you are putting a seed in the soil and you are going to check it and you are uprooting it. It's no longer edible and it's no longer viable. So you are losing on both sides. In order to avoid some of these glitches is why we are putting together an accountability structure and a system that can help you manage your consistency, that can help you take risk-informed decisions, and you are able to manage your wealth from yourself now to the 10th generation, which is my goal as an individual. And I'm calling to you if you're willing to join me on this journey. I'll be sharing a link on this video. You can click on it and indicate your interest if you'd be willing to join me in the Stealth Wealth Hub. Join other wealth creators and let's walk this journey together. Until I see you next time, I am Peace Oladunjoye. Remember to like, share, subscribe, turn on the notification bell for you to know when the Stealth Wealth Network goes live. Until I see you then, bye.